please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
David, Lennox of Fat Prophets, joins us. Good morning, David. Thanks much for finding time for us. Well, what is this largely a dollar fall kind of story, or is there really going to be a supply demand mismatch to the advantage of the bulls?
Oh, good morning, Arthur. Certainly, if you have a look at the headwinds the tailwinds that are driving the price at the moment, you'd have to suggest, and you've mentioned one, there've been a couple of factors that keep popping up. The first is OPEC and its 32.5 million barrel ceiling. There is talk from that particular organisation now that the ceiling will remain beyond 2018 and in fact go into 2019. That's given the market some heart, even though we're still some way from the end of that condition at the end of this year. The other is the fact that markets are now getting a bit concerned that the US may apply sanctions to Iran, and the 3.8 million barrels of oil per day production that comes from that country at the moment may be sanctioned, and that would put a significant hole in the supply. So that's why we've primarily seen the crude and the OPEC oil prices rising.
Okay, so apart from these two reasons, you spoke about the supply cuts extension and the fact that the US may reintroduce sanctions against Iran. David, the other thing people are talking about is the launch of the Shanghai crude oil futures as well, and that will, mark the dawn of a new oil price benchmark to rival Brent and NYMEX. Do you think that changes the dynamics a bit, and how would all of this affect crude over the next, say, 3 to 6 months?
Certainly the introduction of a new futures contract in China will probably see some speculative plays now moving away from the more traditional exchanges where we've seen those contracts resting. China is a reasonably big importer of crude. In fact, it's now probably the biggest importer of crude at around about 8 to 9 million barrels on average a month. So they are a significant player. So that would suggest that any futures contracts that are set up in and any futures contracts that are established in that country will in fact probably be very sensitive to the imports that country does bring about from month to month. However, overall, we don't think it will primarily change the broader structure of the oil markets significantly. What we will see, however, is perhaps a shifting from more traditional exchanges to the Chinese exchange once we've seen the establishment of a really clear trading in that particular contracts.
David, leave us with a range for the next 3 to 6 months and an average for Brent.
Certainly, we're not looking quite that short term. Our end of year price for Brent is between $74 and $84. So already you can see that the price at around 70 hasn't got a lot to go in terms of our calendar year end price. So we would suggest to you that the supply factors that we've talked about will be well and truly matched by the demand factors that are coming into play, and that is the coming Northern Hemisphere summer, which will see prices, we believe, driven a little bit higher. So overall, we would expect to see a more modest increase in the Brent price over the course of 2018, and we'll keep our end of year price, as I said, at $74 to $84.